And looks like we got a full house here before Thanksgiving week kicks off next week. So thank you for joining this evening. Our first thing about everything we have, of course, is on the website, and we send out our quarterly strategies, and under the insights is it's the lots and lots of charts presentation. And this past week we did a presentation in Raleigh and in New Bern, and we did one in New Jersey a few weeks ago. And so wanted to, for clients that we have all over the place on the private client side, wanted to make sure that kind of got the same information that we've been giving out. So I wanted to go through it. I know a lot of people are obviously concerned about the economic environment, especially now that some of the political noise has died down. At least the good news is that's behind us at this point. First and foremost, I always want to talk about the green triangles chart. We've been through so much together over the past almost 30 years, and none of our clients ever had to go back to work. That's one of the really nice things, is that the slow and steady approach that we employ of focusing on companies that have, their quality, durable businesses that pay dividends, it's always been our focus. And so we've been through a lot together over the past 30 years. Some of you are here with me still, and and it's been between the financial crisis that we had, where the stock market declined 50%, the tech bubble of 2000, where we had a 50% stock market collapse, of course, the COVID induced recession, which was a 30% stock market collapse. We've been through a lot together, and we've weathered it. And we've weathered it because you have always received income. So whenever you're worried about something, it could be something as, that you hear on Fox or CNN or whatever your preferred vehicle is. And I always encourage people to listen to both sides. Usually, you have to ask yourself, what impact is this going to have on how much Nestle chocolate is consumed in Latin America? Or, how much Exxon oil is going to be consumed here in America, or, British Petroleum overseas in Europe? And the answer usually is not too much. And that's something to always kind of keep into consideration, to filter out a lot of the noise that you generally hear on television. So it's difficult to do. A lot of investors have a difficult time doing that. It's tough to be disciplined sometimes and chase shinier objects also. But when you stay disciplined or stick to a process, then what's important about that is that you're always going to get rewarded by not trying to get in and out of the market and cause timing issues or taxable issues, but also get the dividends, which you can see these green triangles have always been there for our clients. So if you remember one chart this evening, I would say remember this one. And those of you who have been with us for 28 years, have realized this. None of us ever had to go back to work. We've made terrific returns, over the last almost 30 years for you, and over the last 15 and 10 for that matter. But most importantly is the stability of the income you got. Dick Fold said this to me once during a meeting in New York City, and some of you may remember Dick Fold was the CEO of Lehman Brothers. And Dick said, Jim, your performance has been great, but what I love about your strategy is that if you're a $100 million family office, that client's making $4 million a year, regardless of the ups and downs of the market. And he pointed at me and he said, that puts jet fuel in their aircraft. And I said, Dick, that's exactly our strategy in a nutshell. And whether you have 100 million or whether you have a million, you're making that 4% a year, because 85% of our companies this year actually increased their dividends again this year. So you look at a company like Pepsi, which we've owned for a long time, which has performed extraordinarily well. I was just looking at a chart. People love talking about real estate as an investment. And I look at the house I grew up in New Jersey. And I was looking at this chart, and the house has done well, right? I think my parents moved into it in like 1976. And they paid $100,000 for it. And forget about, let's say they even, the $100,000 that they put into it and the renovation and all the taxes that they paid over the years and upkeep. Um, it would sell for about $600,000 today, which would be a really nice return of about 600%. But when you compare that to Pepsi or Procter and Gamble or the broader stock market over the last, this is just a chart since 1980, it's not even close. Now, people like real estate because they could see it. And we buy real estate occasionally, like we bought Welltower, healthcare REIT real estate during the COVID. Sold it after an 80% gain, and we recently bought Boston Properties after a 50% decline in Boston Properties. But we're usually only buying REITs when we can get the interest rate that we're getting from our bond portfolio, which right now is about 6.9% that you and I, and again, I own the same stocks that you own. So I own exactly the same portfolio that you own. We're in it with you. We're not buying speculative, stupid companies that, don't have real earnings, or even companies that are selling at 100 times earnings. We're buying real companies that pay increasing dividends to you. And as I was looking at this chart, it's remarkable to think just how well, if you worried about all the things that have occurred since 1980. Of course, we had the high inflation during the Reagan years when Paul Volcker raised interest rates. We had a stock market collapse of 87 or 30% in a day. We've been through so much over this period of time. And if you worried about each of these time periods, you would have gotten scared out of stocks and missed some terrific returns. So it's important to kind of take a much longer term approach when investing and focus in on the income. We get paid at Altrius based upon your portfolio value. So I always want to see your portfolio value go up. But regardless, your income has gone up even when the market values have gone down, which is what this chart shows. So yeah, if you've taken out 4% a year, and many of you have been clients for well over 20 years, and you have more money today than you had when you started. And some of you have taken out more than you started with. If you started with $1 million, you've taken out more than you'd be at zero today. And because you've taken out 4 or 5% a year over a 20-year period, and you have much more today. And that's because we've made a nice, prudent, balanced rate of return, 6-7% over the last 20 years. And if you've taken out 4% a year, you have more today than you started with. But all down through all of these downturns, what's nice and what's important to remember is look at the income has gone up. Now, of course, if you're reinvesting, unlike this one where you're taking out 4% a year, if you're reinvesting that like I am, I hope to be doing this another 30 years. I just turned 55 and feel like I'm young enough and want to keep going for another 30, as we approach our 30-year anniversary in a couple of years. And it's important, to realize that we're just reinvesting those dividends at lower valuations when the market's going down. So your income isn't impacted by the ups and downs of the market. I know that you like it when you hit a particular portfolio value. Let's say it's $2 million or whatever your portfolio value is. And when it goes down beneath that, sometimes people get nervous. But as long as you're not taking more income out than your portfolio is producing, we never have to sell a share. We never have to sell a share of stock for you. We never have to sell a share of Nestle. We never have to sell a share of Procter and Gamble. Because you're simply taking the income from the dividends and interest from your portfolio rather than ever having to take principal. And that's something that should help you sleep better at night. So those are the two slides I really wanted to focus in on. This is what makes our strategy very boring. This is what allowed us to weather some tremendous storms. I talk about in the first chapter of my book all the mistakes that hedge funds and portfolios have made over the years. They'll use leverage. They take too much risk with one stock. You'll notice we're generally equally weight with our portfolios. We trim positions when stocks have gone up, and we're buying more shares when stocks have gone down. So when you look at how we manage the portfolio, we're always managing it for risk. We're not taking big gambles. Again, we never use leverage in your portfolio, and that's enabled us to survive some tremendous crises over the last 30 years. So what's the market look like today? Well, it looks, and you're hearing this a lot, it looks overvalued in a lot of ways. It looks overvalued because companies you and I have owned over the past years, like Apple and Microsoft, have just run up tremendously. I remember clients complaining about Microsoft not going anywhere for years, and then of course it just shot up through the roof. And when that happened, we subsequently sold these companies, and now the market cap outweighs of just these handful of companies, all of our companies combined. And I remember being on Fox Business during COVID, and I commented that the S&P 500 was 17% of the S&P 500 with just these handful of mega cap tech stocks. Well, today, and it was actually Lauren Simonetti who during the break, she said, are you sure it's 17%? And I said, yeah, I'm positive. I checked that morning. And today it's 32%. And this is because of the just proliferation of passive investing has just exploded, especially since the financial crisis. And this has just made the bigger. And this is much worse at this point than it was during the 2000 bubble. You have to go all the way back to the Nifty 50 of the 60s to have a concentration of the stock market at a level this high of where we're at today. And this is concerning. And this is why you're hearing a lot of economists, most economists last year, I don't know what percentage it was, thought we were heading into a recession. I wasn't in that camp, and fortunately, you and I were at a solid equity allocation, and we've continued to pare that back down of about 70% for our balanced portfolios. So I thought we'd be in a muddle through scenario, stickier inflation, lower GDP growth, but still a decent economy. And we're seeing that. You see that when we go outside. It's going to be a fine Christmas. You're hearing already from Walmart today, and other retailers are doing well and expecting a decent Christmas. And if you go out and go to a restaurant or you look at auto sales, we've had some really solid. The economy is doing fine, and our companies are doing fine. And that's something I think that's important to kind of remember too when you feel like when you're nervous about what's going on in the economy. But at this point, because of this proliferation of passive investing, the S&P 500 has gotten, and even the Russell 1000, which you have to all the way back to its beginning in 1979, it's 50% now of these large cap, mega cap stocks, the tech stocks. And this is a problem when you look at the market capitalization being this high. That's why you're hearing a lot of economists say that, Vanguard Funds has come out and said we expect returns to be between 0 to 3%. Goldman Sachs has said the same thing. We do scenario analysis, so we don't look at necessarily when you're looking at the worst case scenario and the best case scenario. Certainly over the next 5 years, stocks can go down significantly. That can happen at any time. Getting back to that green triangle chart, if we have the next recession happen next week, tomorrow, or next year, the companies we own are most likely going to continue to provide you the dividends that you need to fund your retirement. And that's part of investing. Part of investing is just continuously hanging in there when we go through these particular downturns. The best case scenario is obviously quite good, but our base case scenario for U.S. stocks and is these are our stocks too. The S&P 500. That's why you're hearing a lot say 0 to 3% over the next decade, and that's because the valuation is so high for U.S. stocks right now. That's not the case for international stocks. We think that international stocks look a lot more attractive, which is why we're keeping a balance between the two, and I'll kind of go over that a little bit later. Investing in what's largest, if you remember back in the early 2000s, Cisco hasn't even hit its high watermark that it hit back in 2000. And it's remarkable if I pulled up a chart again and I replace this with Cisco here, just do that, and you go back all the way to 2000. I mean, look what happened to Cisco. It's just getting back to its high watermark it hit in 2000. Of course, Cisco imploded. Now, we bought it back in here when it was selling at 12, 13 times earnings in about 2005. It started paying a dividend. It was reasonably priced. We didn't buy here. Again, it's tough to stay disciplined. A lot of clients, a lot of investors asking, why don't you own these companies? Well, when you invest with us, we're making a promise. We're not going to buy the stupid speculative stuff just to keep up with Wall Street. It's part of being it's part of being like our mascot here, the aardvark. He's slow and steady and big and ugly like me. He eats the ants. He takes the easy food. He doesn't hunt for big game and get himself killed. He goes out alone and unafraid at night and thinks differently. And that's how we look at the market. And so you look at Cisco, it's still just getting back to where it was all the way back in 2000, 24 years later. And a lot of people, I mean, it was the third largest company in the world in 1999. And you'll probably remember a company called America Online. Who's got mail? Gone. Lucent Technologies. So capitalism is the holiest of all isms, but it's also incredibly destructive in its creativity. And who knows if any of these companies, even Apple, are going to be here 20 years from now. Pretty sure you're still going to be, drinking Pepsi or eating Fritos. But I don't know as much about, when you look at when you look at the companies that I mean, look at IBM in 1980. I mean, it was the largest. AT&T was the second largest of the S&P 500. It's just come way down from those market capitalizations it once was. And look at the energy complex, how large it was at the time in 1980. So America's changed a lot. Investing in the largest companies and investing in what's sexy and what everybody else is investing in, generally not a good idea. And you can see how doing so has well underperformed the broader market. So at Altrius, we of course don't do that. We don't chase performance. So now that the political elections are over and there's a lot of worry about, the elections actually turned out almost exactly how I thought they would. I thought Trump would probably eke out a victory and the House would go with whomever was elected. I thought the Senate would go Republican just barely because of Montana and West Virginia. But America generally is a little center left or a little center right, and you can see this, right? We go from, you look back at the years and you look back at this blue and red. We've gone from Reagan, well, you can go back to Kennedy, and then of course Nixon, and then we had Carter and Ford in that little bit. We had Carter, and then we had a long run of Reagan, Bush, and then we had Clinton. And then we had Bush 2. And after Bush 2, we had Obama for 8 years. And then, of course, we, went to Trump for 4, and then to Biden, and now we're back to Trump. Yet the market has survived and grown through all of these. And generally, when the country goes a little too far left or a little too far right, it gets pulled back. And you see that with this election. Michigan, Nevada, Wisconsin, and Arizona all voted for Trump, but voted for the Democratic senatorial Senate candidate. So again, in trying to keep, and keeping a balance, electors, we often vote in that manner. And, I don't, so because of that, I didn't see any major shakeups occurring regardless of the elections or any big changes. Now, the market acts in the short term radically. So we had this massive Trump rally for U.S. stocks and sell-off of international stocks. Some of you noticed that. You said, how come my portfolio is flat with the U.S. market up? Well, our U.S. stocks were doing great when Trump was elected, but our international stocks were selling off as if Trump was going to have an impact irrationally on how much Nestle chocolate is consumed, globally. Now, he could certainly raise tariffs. The good that's coming from the elections is that we'll likely have less regulations and lower taxes for all of you. That tax that was going to sunset that the Republicans passed will likely be extended in some fashion. The bad is that tariffs can be inflationary, although Trump usually uses them as a negotiating tactic. And so for one particular industry or one particular company, due to a tweet, he could certainly, scare that particular company or scare the market into reacting a certain way. But over time, what you see is a normalization and a snapback. And we've seen that with international stocks already kind of coming back. And I'll get more into that. So for the elephant in the room that all of you are worried about and some still worried about, don't worry about it. We're going to be okay. In this room today, I said this during the dinners, we had Trump voters and we had Harris voters, and we were all getting along just fine and enjoyed the company. And that's one of the benefits of being face to face, is that we could all get along and survive. I often say it's easy for me to call balls and strikes because I'm I don't have a party. My party died with Hamilton. I say I'm a Federalist. I have friends on both sides. I've served with Senator Young of Indiana in the Marine Corps, and we were at the Naval Academy together. I'm also friends with Senator Booker. And and what you find oftentimes is the guys you don't see on television, they talk to each other. And and you're seeing some of that come together already now that the elections are over, and some of the rhetoric has toned down, some of it at least. The good news about the economy is we continue to pump along. So the economy is doing very, very well. Now, this has been our base case, is that we're going to have a muddling along scenario. And again, this may crank up with some animal spirits kind of coming back to the market and some deregulation. But I don't expect major changes here in the economy, but continued GDP growth for the U.S. We're doing exceptionally well here in the United States. And again, you can see this anecdotally if you walk outside and you see people spending money, or go out to the shopping malls, you see people with gifts, they're spending money, and consumers are doing well. Certainly the lower end is struggling more, but middle class, upper middle class, even with the inflation we've had enough wage growth where they're doing well. The good news with inflation coming down is it's given the Federal Reserve the ability to begin cutting rates. Of course, they cut by 50% or 50 basis points and then cut another 25 basis points. I think they're probably on hold for December because the last inflation number, was a little hot, and they'll probably want to see more data. Some more data will come in before the next meeting, but don't expect the Fed to cut aggressively. We still think they're going to be higher for longer, and higher interest rates is not a bad thing. It allows us to get better rates of return for you with our fixed income portfolio. And of course, even if your money is parked in treasuries, again, we manage cash accounts for some of you. On the Treasury side, we're getting nice, 4.4% yields on short-term, 3-month Treasuries right now, which is good. So I think that you'll continue to see the Fed likely be data dependent. There's a lot of debate amongst the board, oftentimes about how aggressively to cut or hold, and the Fed was way behind, for a while there, and they finally caught up. And economists, we have two great periods of time that we can look at in history. We have the World War II, or even the financial crisis, where the Federal Reserve is able to quickly, lower rates to try to incentivize. The problem is, it's the Keynesian pushing on a string issue, is that if they threw a pile of money at all of us, we're not going to borrow it, and banks aren't going to lend it. So it's tough, even with 0% interest rates, to get an economy going during a recession or a depression. And yet we have the 80s, which you can kind of see here, where we had very high, and many of you remember, 16, 18% mortgage rates, when Paul Volcker had to raise interest rates to kill off inflation that we had, during the late 70s. So that was an important, important period of time where economists can learn. And that's what we did here. We know how to fight inflation. It's easy. It's often not politically palatable, which is why it's so important we have an independent Fed. I'm not a big fan of Jackson. I was always nervous when, being a Hamiltonian, I was nervous when they wanted to take Hamilton off the $10 bill. And I said, take Jackson off the $20 bill and put whomever you want on there, because Jackson, of course, killed the bank, and that caused tremendous economic turmoil from the mid 1800s all the way through to 1900. So it was a terrible period of time until the 1913 Act, and we had the creation of the bank. Even Jefferson and Madison saw the importance of a bank, and renewed the charter, the second charter of the bank. And again, Jackson, great general, but economically and probably a horrific mistake. It was a horrific mistake for him to kill the bank, and it took years of depression, including a long depression from 1872 to 1892, and then of course the financial collapse and crisis of the early 1900s. Took JP Morgan to kind of pull us out of that. So, with having a central bank, it's vital. It's not going to eliminate recessions, but it can alleviate and dampen depressions. And that's what the Federal Reserve does. And occasionally, as Milton Friedman has said, is that inflation is always and everywhere a monetary phenomenon, and the Fed kept rates just way too high for too long, and that was really a problem. And when we see it in wages, that's when, I knew inflation was going to be much stickier. When you see this brown line going up in the fall here, the Fed was still saying it was transitory. When I saw it going to wages, I knew it wasn't transitory at that point anymore, because you have to pay people more, especially during COVID, to pay people to come back to work, right? Whether it's making a burrito, cleaning, especially when you have to go back into an office or go back into work, especially when it was dangerous to go back. Getting people back, you have to pay them a lot to bring them back, and that's very inflationary. So, I think in that sense, it's very important that you'll be able to continue to see that inflation is coming down because the Fed has raised interest rates. So again, our expectations for the market returns are pretty muted. Low single digit. We've had terrific returns the last few years. Of course, in 2022, the market collapsed, right? It lost over 20%. You and I were only down a few percent. Our higher quality stocks held up very, very well. And we did very nicely. In last year, our international stocks were up over 20%. Our US were up, I forget what it was, maybe 8 or 9. And overall, we were up about 14% for our equities. This year, it's been the exact reverse. Our US stocks are up 17%, and our international stocks are relatively flat. So, we could see a reversal into next year, and that's again why we have a balance. But our outlook is better for international than US right now. For investment grade bonds, again, not going to get a lot of return. This is where I always think Wall Street gets it backwards. You should take less risk with stocks, but more risk with bonds. And this is where we're always focusing on bonds that pay you for the risk, whether it's a Goodyear Tire or any of the companies that we own, where right now we're getting about a 6.8% return from our bonds. And we've done very well over the last 20 plus years. We've gotten 2% more than a riskless treasury return. And I think that's important to remember, even with any of the bankruptcy potential we've had, and certainly we've had volatility. High yield bonds have been a good spot for us to be, to provide a better return for the fixed income portion of your portfolio than you would get from, say, the Vanguard bond index or the Ag bond index. So again, inflation's coming down. What you'll see probably of interest here is that initially we were all being paid to stay at home, and the price of goods was going up because we were at home just spending on goods and looking around at our house saying, I need to change out that chair or change out the carpet. Now you'll see it's on services because we're all cooped up and people are out spending money again. So services has gone up, much more in the last few years. But overall, all items you can see we're kind of eventually coming down. Goods is actually negative recently, so that's a good sign to see that inflation's coming under check. And importantly, expectations for inflation. You'll notice that. Or actually, this chart's not long enough. If you notice expectations during the 80s, when we had the very high inflation, expectations were very, very high for high inflation, and that wasn't the case for our long-term expectations, which is this green line. The one-year expectations were high as we were going through that inflationary period, but that's come down now, and that's good because sometimes inflation expectations can beget inflation. So at this point, it's nice to see inflation expectations staying grounded. And again, wages are coming down now, and that's a positive thing, to levels where we'll continue with wages coming down and the CPI coming down. That's a positive thing for also keeping interest rates in check. And the real interest rate, well, think of the real interest rate. This is a treasury yield. Let's say the treasury yield is 5%. Minus inflation at 3, well, 5 minus 3 is 2. So the real interest rate, you generally want it to be positive. And when you have, negative real interest rates, and you have very, very low interest rates for treasuries, and you have inflation, that's not positive for an economy. So it's nice to see that we're getting up more towards historical standards here for the real interest rate, and right about where the Fed would like to see it. And again, this is because, wages are coming down because finally we had so many job openings versus job seekers, right? When you had this 2-to-1 mix, you have to pay people because you had all these openings and you had to entice people to come back. And a lot of people just got out of the workforce for good. They said, you know what, I kind of like this staying at home. I'm not going back to the workforce for good. I'm retiring. And that's coming down now too. So we're getting closer to 1-to-1. And that's a positive also when you have the job openings versus the job seekers. So that's a good thing that is coming back towards a normalization. And the unemployment rate, of course, starting to rise a little bit, but still at historical levels, and a positive thing. Americans are never savers. It's part of our pastime. Our national pastime is to be spenders. So we're generally not like some other cultures, very good savers. But we're the last 20 years or so, you can see we're at about 5%. We were super savers here during COVID because we had nothing to spend money on. We were all cooped up at home. But even though savings is coming down, and things that we monitor like credit card levels of consumers, it's certainly rising. But the good news is that the household wealth from a net worth standpoint, due to homes going up in value and due to our portfolios going up in value, has never been higher than it's ever been. So that's a positive, that net worth is up as high as it is. And again, that bodes well for the economy to continue to do well into the coming year. You don't see anything derailing it. That doesn't mean we couldn't have a recession next week. A recession can come at any time. And as long-term investors, we always have to be prepared for that. I often talk about, like, when I'm in a restaurant, if we had a restaurant making $1 million, I ask, what would you guys pay for a restaurant making $1 million? And the answer is usually about 5 times earnings, right? So 5 million is what we would pay for that restaurant. Well, American companies sell at about 17 times earnings from a historical standpoint, if you go back 100 years. Again, the valuation right now is much higher for the S&P 500, whereas our companies are more along that historic level. I'm very comfortable with the valuation of our companies right now. Not comfortable with the valuation of the broader S&P 500. So from that perspective, the market is certainly overvalued, but our stocks are not. And when you're an investor, just like if you're paying 17 times earnings, or if you paid 5 times earnings for that restaurant, you got to wait 5 years to break even on your investment. It takes time, right? And hopefully you can make it a little bit more efficient. But it does take time to kind of overcome that cost. And again, I know that television wants you to worry about every little thing that's going on. But if you did worry about that as a small business owner or as a CEO of a large company, and not think longer term, it's easy to get derailed or panic and pull out of the market or sell your stocks, and that's generally a recipe for disaster. To go back to the one chart I told you to remember, we've been through a lot together, but the green triangles has always been there for you. None of our clients had to go back to work for 28 years, and we've had continued growth of our portfolio, and most importantly, continued income for our clients over that period of time. And that's always been the case. And that's especially for those of you who are close to retirement or in retirement. It should help you sleep better at night. I know it. I don't get much sleep, but when I do, that's the thing I try to focus on. What's interesting about every recession, you'll notice that as incomes go down, and during recessions, incomes always go down because people get laid off and people make less, consumption goes down. If I pay my associates more, they're going to spend more. That's just natural. They may save a little bit, but they're also going to spend more of it. And you'll notice every recession we've had here in this chart dating back to 1960, income has always gone down with consumption following, except during the COVID recession. And that was because we paid people to stay at home, and we paid businesses not to lay off their people. So that was a remarkable period of time, probably the only time in history where income actually went up. And consumption, stayed down at first because we couldn't spend it, but then it went up. So now things are starting to normalize again. You're starting to see, consumption and income come back down to more normal historic levels. But if you're worried about the economy, think about an automobile, right? I'm still driving, or my son is driving now, a 2000 Land Cruiser with over 300,000 miles on it. Nobody needs to buy a new car. I'm personally driving my F-150 that I bought in 2018. It's already 6 years old. It's running great. I'll probably drive it at least another 6 years. I don't see any reason to change it over, and I'm driving less now. So nobody really needs to buy a new car, but people are buying new cars, right? And cars are phenomenally expensive now too, used or new. And when you look at auto sales, you can immediately tell here. Of course, they went down tremendously during COVID, but have snapped back significantly. And so when you see auto sales, that really tells you the consumer's doing very well. And of course, we own Toyota, we own Stellantis, we own these companies, Stellantis, which makes Jeeps and other European brands, and Toyota, which is a Japanese automaker, makes the Camry and others. And we're doing well now. Homes are also going back to historic levels, and we had an inventory problem there for a while that's being corrected. And that's why home prices went through the roof. Now they're stabilizing and coming down some, and inventories are getting better, and home sales are coming back down to more historic levels. And this is a positive thing. So again, the consumer's doing well. Home sales are strong still, and most importantly too, corporate profits. Corporate profits are the mother's milk of stock price returns over the long term. In the short term, the market is a voting machine. People get scared or they get excited. The market goes up or goes down. In the long term, prices follow earnings, and that's what you see right now. Corporate earnings are doing terrific. It's really nice to see companies doing all of what they want to be doing in terms of hiring and investing for growth, yet still producing a profit. And again, 85% of our companies have increased their dividends over the past year, which gets you more income. If you don't need the income, like me, we're just reinvesting it in those stocks. I won't talk about debt. If you have an interest in debt, of course, if you look at debt over history, this is something as a patriot you could worry about. I wrote a blog about it. I don't think I put this in my book, but Japan's been at 200% debt to GDP. We are at historic levels now, going back to World War II, or past the Revolutionary War, in terms of you'd have to go back even further to get to the type of debt that we're at, or I guess the Civil War. But in modern times, we were at about 100% debt to GDP during World War II. And nobody wants to go back to the Carter years. Carter's a Naval Academy grad. We only had 30% debt to GDP. Ireland and Iceland, of course, were nations that were on the brink or went into bankruptcy with 30% debt to GDP. And yet countries like Japan, or the companies that we lend money to, the bonds that we own, like I say, they're like a young doctor. If you're a young radiologist, you're making $500,000 a year, a bank is happy to lend you $1.5 million for a new home. But if your mortgage ballooned in 5 years and the bank went back to that doctor and said, hey, can you pay me back? Well, the young doctor is going to say, I don't have any assets yet. I'm making $500,000 a year. I can pay the interest, but I don't have $1.5 million to pay you back. That's like a lot of the companies that we lend money to, whether it's Goodyear Tire, where you have that 300% debt to the income. They can pay back down their debt. And a lot of countries, America has the income. We have the tax base to continue to pay our debt. Of course, entitlements are going up and becoming a larger portion of that. And that's something that politicians eventually will have to deal with. And of course, the Reagan years, we ballooned the debt. You could say, okay, it was important to defeat the Soviet Empire at the time, or whatever. And it came down a little bit during the Clinton years. And then, of course, went up a little bit during the Bush years, exploded during the Obama years due to the financial crisis, and then exploded again during Trump with the COVID, and then it came down a little bit here during the Biden administration. And so the question is this is the PhD I'll never get, and the Nobel Prize in my confidence theory and in economics that I'll never receive because I don't have time to go get one. But should America be lending more money? I don't know. I like, debt in more historic levels so that we don't worry about these things. But even our Congress people can't screw up the innate advantages that America has with our natural resources, and most importantly, the grit of our people and our immigrants who come here to continue to make this economy, strive. Not to mention, the freedom and lower regulatory issues that our nation has. And it's just a great place for companies to come and innovate. And it's just a miracle of capitalism that's happened here in America. And, if you go back to the early 1800s, 90% of the population was in abject poverty. And today, it's about 7-8%. And the Industrial Revolution and capitalism drove all these people out. And that's a there's a miracle of capitalism that we have. And that's likely going to be able to continue. And I don't know what the right debt amount is. I know those on the right are really concerned about it, and those on the left want to spend more money, as if it, is never going to be an issue. And so that's a big question mark because we don't know the answer. Again, Japan's been at 200%. We're at higher levels than we've been. Eventually, this may become an issue where America will have to pay more because people get worried about us. But fortunately for us, we're the best looking person in an ugly dance because you look at the dollar. We are the reserve currency of the world. The Chinese can't be, the Russians, the ruble can't be, the euro, and all of the dysfunction between those nations or differences in opinion between those nations cannot be. The Swiss franc is too small. So we're very fortunate that we have advantages that the rest of the world simply does not have, and that puts us in a tremendous advantage. But as an investor, I don't want you to worry about this. You're going to hear about this problem. You're going to hear a lot of noise about it. You're going to hear a lot of, in this case, Republicans fighting Republicans about trying to get this situation under control, deficits and debt. But as investors, capitalism will find an outlet somewhere, and it's not going to impact the portfolio. It's another reason why I think it's important that we keep a balance between international and U.S. stocks. So again, the market is overvalued, way overvalued. Very concerned about the S&P 500, which again is consisting of these, what I call the fat man stocks, or some call the Magnificent Seven: Facebook, Amazon, Tesla, Microsoft, Amazon, Apple, Alphabet, Netflix, and Nvidia. And it's remarkable what these stocks have done, but the valuation is just getting silly at this point. And that's why, again, you're having Vanguard funds and Goldman Sachs and other analysts say, hey, the returns for U.S. stocks over the next decade, 0 to 3%. And that's quite possible. Again, our stocks are not even close to that. And when you look at, the market valuation minus just those 7, it's more towards historical standards for the market. So again, our companies are even less than that. International selling at about 11 times earnings, very cheap. So we're always going to focus on value. Everybody was a Warren Buffett acolyte. Value outperformed growth during the 80s and 90s, and then the 2000 bubble hit, and that wasn't a pretty end. You can see here, and I showed you that chart of Cisco finally getting back to its high water mark 24 years later. And we, of course, for those of you who are clients in 2000, we didn't implode 80% with the NASDAQ. We didn't go down 50%. We went down about 12, I believe it was, in 2000, in the early 2000s there. We held together very, very well. Just like 2022, the market got killed, and you can see value came back there in 2022. We were flat, and the market was down about 20%. Now, again, this inversion has happened where everything's pushed back into growth because of that proliferation of the S&P 500 being dominated by those Magnificent Seven. We're not going to bite, though, because it's, again, overvalued. And eventually, you'll see a return to where valuation matters again. I always say 3 things matter when investing: valuation, valuation, valuation. And that's an important aspect here, is that we want to, stay disciplined and not bite on things that are overvalued that can blow up your portfolio or blow up, our company, which is investing side by side you. Same thing is true here for U.S. versus international. The U.S. market has had quite a run here, really since the financial crisis, massively outperforming international. These things kind of go in waves. And don't be surprised if you see, a snapback next year for international stocks outperforming U.S. stocks. Again, I don't think Trump's going to have an impact or put massive tariffs. The first time Trump came and he said he was going to put 40% tariffs on, it wound up being 7 to 25. He uses them as a negotiation tactic. This time he said 60%. I'm sure it'll be targeted. We'll see what they wind up with. He uses it to negotiate, and we're already seeing nations come to the bargaining table, and that's not a bad thing. So I think that again, we're keeping a balance between the two. Valuation is much higher for U.S. stocks than Asian stocks or European stocks or the UK for that matter. You can see valuations are just cheaper across the board. And as far as the bond portfolio, at this point, we're kind of range bound. We finally saw the inverted yield curve get back to normalization, not so much on the lower end because it's expecting the Fed to keep lowering rates. And you're seeing that, here on the longer end of the curve, the Treasury kind of start to get back to a normal normal levels of a yield curve. And the bad news is that returns are going to keep going down from these. So basically, the yield that you have on bonds is what we're at with the Fed starting to lower rates. So we're not finding any value here in lower grade bonds. So how are we positioning portfolios? Well, we're keeping an equal balance between U.S. and international stocks, even leaning a little bit more towards international, this is the first time we've been in this type of position in my 28 years of managing portfolios. It's just too compelling for us not to have a little bit more international exposure at this point, especially because you're getting a much bigger and fatter dividend at 4.6% yield. We're at about 3.8 here for our U.S. portfolio, and stocks are just cheaper. And then the other 30% of your portfolio we have in our fixed income portfolio. This is for our balanced strategies for the great majority of clients. And again, this is exactly how I'm invested. It doesn't matter for us where a company is headquartered. It matters more where the company is selling to. It doesn't matter where Pepsi is headquartered. I tell the story of I wrote a note to the CEO of Pepsi, and I told him that thank you for taking care of our shareholders. He was a 1970-something Naval Academy graduate. And it's no mistake that his CFO, Ingenuity, became the CEO because the growth potential really for Pepsi was overseas and in India. And she did a great job stewarding the company and continuing to grow Pepsi and its brands across the globe. If Pepsi moved out of America and moved overseas, it wouldn't matter. It doesn't matter where the company's headquartered. It matters more where the growth is coming from. And so the revenue by geography is very important for us. We want to see global growth. We want to see dividend growth. We want to see durable companies, and we want to see dividends that are, and valuations that are reasonably priced. That's all important to us when we're managing, your portfolios. So again, indexing right now, the market is way overvalued and yielding very, very little. I think the S&P is at about a 1.4% dividend yield. We're at a much higher dividend yield, and you're getting much higher income. This is, again, where you do not have to sell. We don't have to sell any shares of the stocks we own for you when you're taking out 4% a year. You're just taking the income naturally out of the portfolio. It's not a throw and hope. We sell our ETF to financial advisors across the country, and they chuck their clients in, 20 different ETFs, ours being potentially one of them. Ours is the value component. They're hoping they're getting about a 2% yield for their clients. They're hoping they get the growth that they need. We're never investing in hope. We're investing in cash flow for you, so that you don't have to hope for growth. You're going to get growth to hedge inflation and taxes due to price appreciation, but you're also going to get dividend growth, and you're going to get the income to fund your retirement. And if you don't need that income, like me, you're just buying more shares and increasing your future income potential. Again, our bond portfolio is yielding about 2% more than you're getting from safe core bonds and treasuries right now. We think, and we're always staying short term. I talk about the importance of staying short. This is what blew up the banks. What happened to banks is they were going out 3, 5, 6 years to get 1% more interest on zero, and when interest rates were 0 to 1%. And when you had a run on the banks, they blow up. If you put $100,000 and you put it into a 2% yielding 15-year bond, well, you lost 2% over 15 years as soon as rates went up 2%. So your portfolio, your $100,000 bond would immediately go down to $70,000. And we're never going to go long. All we're worried about is default of our companies. We're not worried about interest rate sensitivity, because we're generally staying, historically, we've always stayed between 2 to 4 years, so that we don't have interest rate risk, or much limited interest rate risk for our bond portfolio. Same thing for our stock portfolio. Again, much cheaper, much higher dividend than the S&P 500. You can see at 1.4% dividend versus ours. And same thing for our international. We've always paid a higher dividend. Same thing with our international portfolio, much higher dividend, much cheaper valuations. So with that, I'll open it up to questions. I know I went through a lot, and happy to go through any other slides or questions that you may have regarding our outlook right now, and anything you have. So Sharon, if you could open it up to open up the mics, or you could raise your hand or send me a chat in the chat box, and send out any question that you may have. There's got to be some questions out there. I know there's a. Or maybe we don't have you unmuted. Sharon, you got everybody unmuted?
No, there's no way to blast unmute.
What do you mean?
I'm looking for that. All the unmuting is individual.
All right. Well, I guess click everybody and unmute. Unmute as you go. So I could click them. Or you could raise your hand, I guess, or hit the chat box if you have a particular question, then we could find your thing and then unmute you. I thought there was unmute. It's weird.
No, you can mute, but not unmute anyone. Because then you could listen in to somebody without them knowing.
That's interesting. All right. That's why we didn't have any questions. No, everybody's on mute. Not everybody's on mute. I don't see any meeting chats or Q&A. You could type in if you have a question in the to start a discussion, or if you had a question, you could type it in. Here's a question from Mike on any new thoughts on crypto. Yeah, so that's one. Yeah, so to call it cryptocurrency is really a misnomer. And I've got a Bitcoin right here. And let me grab it for you. So here's a Bitcoin, and this is worth what today? About $69,000. Does anybody want to send me $69,000 and I'll send you this Bitcoin? Now, of course, I don't know what Bitcoin is, and we may go back to the days where we're all using wampum as trading, shells like we did back in the early Americas. So you can make a currency. I can make an Altrius coin today. I can make this into an Altrius coin, and you and I could decide Altrius coin is worth an initial value of 1,000, and then we keep bidding it up higher and higher. But for something to be a currency, I always say these at the dinner meetings, I can't use it yet. I can't use Bitcoin to pay the restaurants. And if I did, they would immediately convert it to $1 anyway. And currency has to be a stable store of value and a medium of exchange. So it's not yet a medium of exchange. Could become one like wampum. It's certainly not a stable store of value when it goes from 10,000 to 20, back down to 4, up to 60, 70. So it's, and lastly, I would define currency as having to be backed by a governmental authority. It has to be a taxing authority. Otherwise, I don't really know how reliable Bitcoin is going to be, or Doge. People who like Elon Musk, and I have a lot of high regard for Elon Musk. He likes Doge for some reason. Is Doge any different than Bitcoin? No. Is Doge going to last? I don't know. Is Bitcoin going to last? I don't know. But it's not a currency. So what is Bitcoin? Well, it's not the blockchain, right? All the companies we use, whether the large companies like Bank of America that we own or Citigroup, they're using blockchain technology. That's not it. It's more like maybe like fine art. Now, I know a banana peel that sold, a banana that was taped with duct tape to a white wall was sold for 140,000, and somebody's going to be bidding 1.1 million for it. Doesn't even come with your own duct tape. You have to figure it out. I kind of like the guy who just did it at the Mall of America, who just did the World War I, and he said he likes Renaissance people. He doesn't like these artists who just consider modern art, or there's a lot of subjectivity to those type of things. Whereas when you look at the David, you realize like, well, that's a remarkable, work of art. But even that, that work of art, like a fine wine, doesn't produce any income like real estate or stocks do. And we showed you a picture of the stock, versus the house I grew up in. It doesn't produce anything. It doesn't employ anybody. It's just what somebody is willing to pay for this coin, or a tulip. If we went back to the tulip mania, I was talking about the Sir Isaac Newton as as one of the I remember he lost his fortune, and I was showing Max the beautiful architecture inside the New York Museum or library, and Sir Isaac Newton. He had a thing where so he can understand the movement of the stars, but not the madness of the people. And he invested in what was today's Tesla or today's Nvidia. At the time, here I'll just show you a quote. One of the first publicly traded companies was the South Sea Company stock. It was a crash in 1720, much like tulips, until people said, "Wait a minute, this is a tulip," that was going for the price of a house. And by the way, if you don't use AI for stuff, Perplexity, Google could be in trouble over time. Perplexity is just a remarkable, I showed you how some of these companies, they're selling at very high valuations. Perplexity, do a search on Perplexity and you'll get, terrific results from it. And also have, much like this one, you see the footnotes that are in it. And Google's starting to try to catch up to Perplexity now. The crash that occurred, he lost his life savings, roughly, you can see, 3.1 million dollars at that time. And it was a tale, it's a cautionary tale about how even the most brilliant people can lose their money. And the exhibit at the New York Library had this on there about booms and busts throughout history, including the tulip and this Sir Isaac Newton quote. And I think that right now, Wall Street always likes the sexy, shiny object that's out there. And Bitcoin is sort of that sexy, shiny object everybody thinks new, but is it going to last? I don't know. I can tell you, and I can promise you, Mike, that we will not be investing in it. Now Trump has talked about, formalizing it more. If he had a digital dollar, then that would be stable store of value. It would be a means of exchange, and it'd be backed by the U.S. currency, and that would certainly make sense. I think for privacy reasons, a lot of people don't want that, right? They kind of want to use cash and be able to, do things that are sometimes nefarious, or sometimes they just don't want their spouse to know about and use cash. So I think in that sense, you may not see a digital dollar, although China's also talked about possibly doing that. Now, to go to this shiny thing too, a lot of people go to gold. Gold has always been the price of a nice man's suit. And I always say I haven't bought a suit in, I don't know, 15 years, but if I bought a Canali suit, a nice suit for sale here, you can see at Nordstrom a Canali suit, which I usually buy. Last time I bought it, I think I paid $900 for one because I always buy it on eBay. But if I bought one from Nordstrom or Neiman Marcus, a Canali suit costs about $2,200. And if I went back 100 years, an ounce of gold, goes up with the price of a nice man's suit, even if you go back 100 years. And that's what it, inflation or a basket of commodities, which you and I haven't owned for a while. If I feel like there's going to be inflation, then we may buy. I'd rather own the miners though. But if I took all the gold in the world and I pulled it all together, we would have a 67-foot cube. 67 foot deep, 67 foot high, 67 feet wide. And it would be a big, brilliant cube of gold. And I could look at it and say, wow, isn't it shiny and beautiful? And it's mine. But again, it doesn't produce any income. I'd rather buy the gold miners. But for that same cube of gold, I could buy 7 ExxonMobils, 7 ExxonMobils, all of the farmland in America, and also have about $1 trillion of walking around cash. What would you rather own? A 67-foot cube of gold that you could shiny and say and put it in the middle of your town? Or would you rather own 7 ExxonMobils, all of the farmland in America, and $1 trillion of cash? The answer is obvious, of course. And from that perspective, whether it's Bitcoin as the new digital gold or whether it's gold itself, we're not going to get involved in that speculative mania, although it's tempting to do so. So it's what lost Sir Isaac Newton all of his money. Some say he was the most brilliant physician. I'm a little bit, partial. I'm half Polish, so of course Copernicus, and then Italian. I have the same birthday as Galileo, and of course Da Vinci was truly the Renaissance man. So I'm partial to the Italian mathematicians too. But Sir Isaac Newton is certainly one of the world's most brilliant mathematicians, and he went broke because it was just too hard not to succumb to that temptation of that shiny object. So those are my thoughts on crypto, and I hope that answers your question. May not be the answer you like, and I always say if you're going to invest in this thing, if you don't want to send me, what's the price of a Bitcoin right now at? Let me see. Today, it's at $91,000. You can send me $91,000, and I'll send you this coin that I got on eBay for about $1, I think. For 15 of them, so I could teach my kids a lesson about speculation. But I think just don't put any more in it in your side account than you want to lose, because it could end very badly for cryptos. Any other questions that you may have? Since we're having trouble unmuting you, you can. Oh, thanks, Mike, for the thumbs up. Glad I answered your question. You could throw it in the Q&A session, or you could just throw it in the chat box here. You could just send it to me privately too, or you can send it out to the group if you want everybody to see it when you're typing in a message. We couldn't have solved all the world's problems tonight. I think we got most of them now. So hopefully we answered most of them. But we, at Altrius, because we're invested side by side, we deeply appreciate the trust. The 600+ million that we manage, we don't take that lightly. It's probably why I don't sleep much. And we're always going to stay disciplined in our approach. And over these past almost 3 decades, we deeply appreciate all the trust that you've put into us over this time. And we're extremely thankful as I approach Thanksgiving. Very deeply grateful for your trust over these many decades. And as always, if you email me at a Friday night at 11 o'clock, you're going to get an email back. We're always working for you, and we'll continue to do so to try to find value for you. So thank you for. I hope you have a wonderful Thanksgiving with your families, and really appreciate your time tonight. And if I don't talk to you before the holiday season too, have a wonderful holiday season. So thank you so much.